Hey, what's up, my friend? So, in today's episode, right, I want to share with you when should you not put on a trade. So before we get started, I get some comments from you guys and girls, right, telling me, hey, Reina, you look tired, man. Get some rest. You need to rest well. You don't look too good. So, in today's episode, I brought a cup of coffee along the way to hopefully perk me up, right, while producing this episode. So let's get back to our topic, right? When should you not put on a trade? So here are a few things I look for, right, before I put on a trade. Number one, the price, right, must not be far from the area of value, right? If the price is far away from the area of value, I usually will not want to put on a trade. So what do I mean by this? So imagine that the market, let's say it's in an uptrend. It respects the 50 period moving average. Every time it goes up, pulls back towards the 50 MA, bounces, go up higher, pulls back to the 50 MA, bounce up higher. So you can see that this market tends to, find potential buying pressure at the 50 period moving average. So the 50 period moving average serves as an area of value. So clearly, if you want to be buying in this uptrend, you don't want to be buying when the price is far away from the 50 period moving average, because when it makes a pullback, you will likely get stopped out of your trade. So this is what I look for. I always look at a chart and ask myself, where is the area of value? Once I've identified it, right, I want the price to be trading near the area of value and not far from it. Because if it's far away from it, chances are I will get stopped out on the pullback. Okay, so that's the first thing, right? The price being far away from the area of value. Number two, chasing breakout. So chasing breakout is again, right, a big no-no. And why is that? So the reason why many traders, right, love to chase breakouts is because it's exciting, right? You look at the market, oh, it's so bullish, Reina. Look at the huge candles, right? 3, 4, 5 green candles in a row. And usually when you see such price action, it's a warning sign. It's a red flag that this market it's a bad time to enter. Because when you chase after the market has made, such a big move within a short period of time, it needs to breathe, right? Imagine you sprint 50 meters, right? Give it your all. Let me ask you, what are the odds of you, sprinting the next 50 meters at the same capacity that you have done earlier? No, right? You need to rest, you need to pause. And the same for the market. If it moves too fast, too soon, right? Chances are it needs to pause, it makes a pullback, and sometimes even a reversal. So don't chase the markets, right? I know there's two conflicting feelings down here. Number one is that you're afraid you might miss the move, right? You might miss the next big wave coming up. And the second thing is that, based on your own experience, right, the number of times that you got caught chasing the markets, you know that it's the wrong thing to do, right? So don't chase the markets. And that also will bring us to another problem, which I will explain shortly. Number three, don't put on a trade, right, when there is no logical place to set your stop loss. So let's say, for example, you chased the market earlier. The market closed bullishly, right, for 5 days in a row. Huge, big bullish candle. And you think that, oh man, the market is going up today, right, for sure. Guaranteed. So you go long on the 6th day. And by doing that, right, you would realize that when you chase the market after it has made a huge move, there is no logical place for you to set your stop loss. So what do I mean by this, right? So if you chase the market, let's say you're long, you're bullish, you want to set your stop loss, right, at a logical level. A level, right, an area where market has difficulty, breaking below. For example, an area of support. For example, could be a respected moving average. For example, could be an upward trend line. But when you chase the market, there is no such price structure that you can lean your stop loss against. Because when you chase the market, right, the market is so high, right, and there is no price structure, right, to support these higher prices. Because it's not like a slow and steady uptrend where you have a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, where you can reference the previous swing low to set your stop loss. When you chase the market, right, such price structure is not available for you to set your stop loss. So when it reverses, right, it will be, usually swift, right, towards the downside as well, and that's how you get stopped out. So if you don't have a logical place to set your stop loss, right, maybe because you are thinking of chasing the markets, maybe because your stop loss, or rather the nearest price structure, is very far away, then forgo the trade, right? Don't put on a trade. Okay, so that's the third thing. Number 4, your risk is too large. So sometimes, right, this is especially for those of you who have a small trading account. So sometimes you follow your trading plan. Okay, trade with the trend, area of value, you know where to set your stop loss. But because your account size is too small, right, and maybe if you're trading stocks and the stock has a very high dollar value, you realize that even if you set a proper stop loss, right, your small account size is not able to withstand it. So instead of risking the usual, let's say, 1% risk of your account, you realize that if that trade hits your stop loss, you might lose 30% of your account, even though you are trading according to your plan. Then my suggestion is, again, right, don't take the trade, even though it meets your requirement because your account size is too small to handle it, right? So just forego that trade. Maybe you want to trade a stock that it doesn't have such a huge dollar value to it. Maybe trade other markets like FX where you can trade nano lots and stuff like that. Okay, and fifth one, right? The final one is that don't put on a trade, right, when you want to get even with the market. This is especially after a few losing trades, right? You follow your plan religiously, right? You buy uptrend, you short downtrend, and you still suffer losses, and you feel angry with the market. You want to get even with the market. And usually when you want to get even with the market, you find all sorts of lame excuses to get back into a trade. For example, let's say you buy in an uptrend, you got stopped out on a pullback. When the market breaks above the previous swing high, your thought might be, oh, I'm still trading with the trend, right? Price is about to break higher, I should go long right now. And you just find some lame reason to hit the buy button. And that's, getting even with the market. Because when you get even with the market, your emotions take control. When your emotions take control, your actions becomes inconsistent. And when your actions become inconsistent, your results become inconsistent. And you might even, suffer, right, blowing up another trading account. Right? So don't put on a trade, right, when you know, right, consciously that you're trying to get even with the market, when you want to revenge trade. That's usually a big red flag as well. Okay, so as a quick recap, here's what we have discussed today. Number one, when should you not put on a trade? When the price is far away from the area of value. Number two, when you are chasing breakout, when you're chasing parabolic move, when the market has moved too fast, too soon, right? That's usually a bad time to enter a trade. Number three, there's no logical place for you to set your stop loss because the nearest price structure is very far away. Number four, your risk on the trade is too large. And number five, when you feel that you want to get back at the market, get even, revenge trade, that's where you should not put on a trade as well. So with that said, I wish you good luck and good trading. I will talk to you soon. And the coffee says bye-bye.